Bittensor is a federation of hundreds of thousands of Tao holders that no company can buy. There is no single AI company that has hundreds of thousands of equity holders. Not Anthropic, not OpenAI, not Mistral, not Grok, not Cerebras, not even NVIDIA. Bitcoin is not a hedge against inflation. It is the solution to inflation in the context of fiat. Necessity is the mother of invention. Constraints drive creativity. When you have an absence of necessity and an absence of constraints, guess what happens? Things fall off the rails. It is not a right, it is a privilege to have the world reserve currency be the dollar.
So JJ,
how's it going, James?
Yeah, good. It's been about a week. I feel it was like 20 years ago, the last podcast, because in crypto years, every day so much happens that basically the day before is already out of date. Like even in the Tao ecosystem, there's nonstop stuff happening, with new subnets, old subnets, and then in the Tao ecosystem itself, there's going to be, an upgrade with raising the subnet cap, and there's going to be deregistrations. And it's always fascinating. One of the things I really love about talking about Bittensor and thinking about Bittensor is the creativity of these subnet designs, of all the different ideas being plugged into these subnet spaces. One thing though that's always hard, and Bittensor's got such a strong community compared to other cryptos, but it's like if somebody asks me, what is Tao? It's actually, I can answer it, and I feel like I'm pretty good at answering it, but it's always difficult. It's always, because first off, it's difficult to explain. If someone asks, what is Bitcoin? That by itself is difficult to explain.
Yes.
What are stablecoins? That should be easy to explain, but turns out to be more difficult to explain than people think. And then you throw in Bittensor, it's difficult. Like, how do you normally explain it when someone says, hey, JJ, what is this Bittensor thing you're obsessed with?
It's a really good question. And I'm remembered of a quote by Satoshi Nakamoto on July 28th, 2010, which was on the Bitcoin Talk chat. And someone was asking some questions about what's the solution to sort of explaining Bitcoin to people? It's too complicated. It's like very complex system. And Satoshi responded with some technical comments and then said, if you don't believe me or don't get it, I don't have the time to try to convince you. Sorry. So unfortunately, the Bitcoin community has had this issue. It still has this issue, obviously.
Yeah, I remember when I was first kind of writing a lot about Bitcoin. This was in 2017. And people in the crypto world actually were very angry at me because I didn't like using any words like hodl or, any of the normal words that the Bitcoin community was using. I wanted people to understand this was an evolution of money, just like every industry evolves ultimately. So like medicine evolved from praying to your shaman to, take 2 aspirin and call me in the morning to now AI reads your x-rays and can totally diagnose you. Like medicine in general has evolved over the years and centuries. Every other industry has. Now money is. So of course we went from barter to gold to fiat to crypto. And it's such a huge evolution. But now you can finally say, if someone says, oh, well, is anybody use crypto or Bitcoin? Yeah, there was $27 trillion worth of stablecoin transactions last year. Enormous use case that's only growing. And there's all the infrastructure around that with lenders and exchanges and payment systems and blah, blah, blah. And then now with Bittensor, enormous use case. Ridges is going to be the leading, AI for generating code. Bitmind, leading AI for deepfake detection. I forgot the name of it, but the subnet that does the 3D AI, leading AI. It's the leading AI in the world
Gen.
now for 3D. Yeah, 404 Gen. So, and on and on. We could keep listing these subnets, and they're only like 6 months old. So it's like ridiculous. And
it's pretty crazy.
These are like the two biggest use cases of crypto, essentially AI and DeFi. And you can't even argue about Bitcoin anymore. But it's still hard to explain.
It's still really hard to explain. And I think I saw a tweet from Michael Saylor recently kind of going on about, Bitcoin is these sort of properties. It's money, it's digital, capital, it's sort of this bank in cyberspace, it's all these things. He kept going and going. And, he said it's all these things. And I think when a complex sort of concept satisfies many definitions and sort of like is many different things at the same time, this is sort of inherently confusing to people. Humans don't really like to think. This is something that I've like realized as I've gotten older. I enjoy thinking, like I get pleasure out of it. I like being alone and just thinking. I think most people just think that they regard thinking as a chore, as sort of like work. To some people, it's pleasurable. But when you have a concept that is sort of like paradoxical, that requires thoughtfulness to sort of have a holistic understanding, a lot of people just tune out because they have to actually think in order to understand something. And so that's why we have useful sort of short phrases, catchphrases for things. Bitcoin is digital money or digital currency. Bittensor is digital, decentralized AI or permissionless AI. I think what we've done in this podcast over almost 10 episodes now is really try to peel the onion on what is Bittensor beyond decentralized AI, or this notion of humanity-owned, humanity-controlled AI. And it really goes to incentives. And I think you've kind of changed my points of view a lot on kind of looking at capitalism and how does Bittensor kind of intersect with upgrading capitalism or kind of providing a new way of doing capitalism. And then we talk about the purpose of incentives and what is the fundamental usefulness of an incentive that anyone can shape and harness to deliver a more powerful outcome than would be possible with a company or with a startup, where you have to go and get permission from 5 or 6 different entities just to make progress. And a lot of these things are not really familiar to the mainstream because most people don't start companies. Most people don't encounter interfacing with the government to get permission to run their business or to do any of those things. Most people are just sort of passive, and either they have a job or they don't have a job, and they're sort of like reliant on the actions of others to produce prosperity in society and to produce economic outcomes. My personal sort of most compelling way of understanding Bittensor, like what is Bittensor, is it upgrades equity. And when I use the word equity, what I think a lot of people might hear is sort of like, fairness or outcomes or whatever. I'm not talking about that type of equity. I'm talking about company equity, stock, right? When you're an employee of a company, you might be given stock options. When you're trading on Robinhood, you're going to be buying stocks of companies that are traded on the NASDAQ or some stock exchange. That's what I'm talking about. I'm talking about this invention that goes back about 400 years, where we created basically a third-party entity called a corporation. And that corporation has a sort of embodiment of its own. And the representation of that is this thing called shares. And people own those shares, and you can stake claim to some future outcome of that business based on your ownership of those shares. And so this notion of shares has been around in society for actually much less time than the notion of currency, than the notion of fiat currency, going back to the Roman times and many years before that. Like, there's coins, and then seashells, and then paper currencies, and then we have, sort of bank ledgers. I think the world of fiat currency goes back many, many thousands of years, but the notion of the corporate share, stock, equity sort of asset, corporate asset, goes back to, I believe, the Dutch East India Company, which is about 400 years ago.
Yeah, around the 1600s.
Yeah, you had a proper notion of like, there's a business, it could be owned by the government, it could be owned by citizens, it could be owned by normal people. It's typically people who started those businesses were the owners, and everyone else was just sort of like subservient and working for the corporation. And so what Bittensor does is it sort of like completely upgrades the idea, the notion of corporate equity, of company equity. For me, that's the most compelling sort of way of understanding Bittensor. And I've actually gotten a lot of resistance to this sort of like focus on Bittensor as a replacement or like upgrading company equity, because a lot of people really want to focus on this decentralized AI thing because it's this big hypey, trend, and we're going crazy over NVIDIA, and everyone's just like super focused on AI and like all this AI stuff. But the reality is AI is going to be a transitory thing. Like in the 50s and 60s, people were obsessed with computers when they started to kind of emerge, and then the internet happened, and everyone's obsessed with the internet companies. And we went through that kind of bubble, and now we're obsessed with AI because of these LLMs and these chatbots. But in 5 or 10 years, we're not going to be talking about AI. We're just going to be talking about, well, this is just the way technology is. That's just the way technology works. Is like AI. Like imagine kids being raised and growing up around using these models on a regular basis. They just assume the computers can actually think and generate, photorealistic images and video and text and all of this. They assume that's how computers work by default. They don't have any notion of prior paradigms of technology development that got us here over decades and decades of scientific discovery.
Yeah, it's interesting that you say this, and I'm glad we're going down this route. I love the fact that so many AI, products and ideas can be re-implemented in Bittensor even better than in centralized AI. And again, Ridges is a great example. They're up against the $183 billion valued Anthropic, and they're going to crush them. They're already side by side with them on all the benchmark tests, and Ridges has spent a total of, $100,000 and change, and, in the lifespan of Ridges' existence. And Anthropic, again, has spent billions of dollars. But what you're saying is very important, that what Bittensor really does is, just like I said, how Bitcoin was an evolution of money. Money's been around forever, and crypto is the latest evolution of money. Bittensor, these alpha tokens, these subnet tokens, are an evolution of equity. And we touched upon this last time because last episode and the episode before, I was really concerned, are people, whether it's subnet owners or investors, are people really taking these alpha tokens seriously? Like sometimes even subnet owners don't really understand that these alpha tokens are not equity in the traditional sense. But first I will state, even equity is not equity, in the sense that investors say, oh, I'm going to own some stock and the stock's going to automatically go up if the companies go well. Nassim Taleb has this phrase, you need skin in the game. And he points out that equity is essentially worthless in a company if the management of the company doesn't have skin in the game. Oh, so you have the book. Yeah, you have all of his books, which is great. Nassim's been on my podcast. He's a very good guy. I love his books. And but he points out that if the CEO of McDonald's doesn't own any shares of McDonald's, then he might not care at all about the fact that you own shares of McDonald's. He's cared about his pay package and his incentives. He doesn't care about your incentives. And so that's why, stock analysts, they don't just assume, oh, I'm going to buy equity because it's going to go up if the company does well. It might not go up. If the CEO is just issuing shares to himself and management team and other big investors, the equity might go down even if the company does well. So it all boils down to incentives. And Bittensor makes sure that the alpha tokens and the incentives of everybody really align with the incentives of the subnet owners and the needs of the subnet owners, or else the alpha is going to go down. So Ridges, again, is a good example, and I'll explain why. Because Ridges is already the best model for let's call it text to code or AI coding out there, centralized AI, you can't throw more money at Anthropic, and Anthropic's going to crush Ridges. Without any money, Ridges has already surpassed a company that's had billions of dollars thrown at it. So what that tells you is that Ridges cannot replace the decentralized element that Bittensor provides it. So the miners are critical to the growth of Ridges. If Ridges is going to even survive and continue to grow, the miners have to be incentivized or else they disappear. And the miners are incentivized with alpha tokens for the success of Ridges to continue. And Shaquille, the CEO of Ridges or the founder of Ridges, he is 100% aware of this. The alpha tokens have to be infused with as much value as possible, making it a good investment for investors, a good deal for miners, a good deal for Shaquille as the subnet owner, a good deal for validators. he has to continue with the decentralized model because there's no other choice. And so he will make the alpha tokens of value. That's a bet you can make unless you think somehow he's like, nobody could buy ridges and say you don't need your miners anymore. We got you, because that's the only way he can succeed. The flip side, and this is not a bad thing, looking at Targon or any of the subnets that provide compute, they provide NVIDIA GPUs for very low cost because miners contribute the NVIDIA GPUs in exchange for the alpha tokens. Potentially, Google could go to Targon and say, hey, we're going to acquire you. We like your brand. We like your customer list. We got NVIDIA GPUs. You don't need your miners anymore. That could potentially happen, but knowing that the Targon management team, and JJ, I know you're an investor in Targon, the Targon management team, because they're not owned by Google right now, they're essentially building their business with the miners in a decentralized Bittensor. They still have to infuse the tokens with, the alpha tokens with a lot of value, knowing that people could consider that they might get acquired at some point. So the miners need a lot of value to keep mining. So all of these things is going to happen on Bittensor, and I think it's still maturing and evolving. There are still many subnets out there that don't realize they need to give their alpha more value. But subnets like Targon, Shoots, Ridges, and many others are realizing this more and more every day based on my discussions with them.
Yeah, it's really fascinating. And obviously this is an extremely rapidly evolving
Yes.
and speculative domain, but sort of the notion of how does value get represented in equity is also a highly evolving and changing, right? Like, we saw Oracle stock go up, 50% or something in the last week or so after the announcement of a contract pretty much everyone knows is not funded. And neither party has the resources currently. And it's just a contract. And what's crazy, and I think this is actually somewhat like meme stocky of Oracle, is they issued a forecast over 5 years of what the revenue would look like. And again, the contract is not actually funded and the resources are not there. I mean, no one has $300 billion of GPU compute available to basically provide any compute provider. And
I don't even know if NVIDIA could make that many chips.
I think they can, but it would be over many years. And it's on the assumption that they can actually get the allocation needed to do that. And obviously there's all these other variables and supply chain dependencies and stuff. But I just think it's kind of interesting that there's real liquid equity value there in a stock, right? Which is Oracle's, public company, been around for decades, run by Larry Ellison. And all of a sudden, the shareholders of Oracle are benefiting from this gigantic appreciation purely based on a speculation that many parties will actually be able to deliver on this contract. And if they don't deliver on the contract and something happens, then obviously the stock is going to massively collapse or at a minimum come back down to where it was previously. And so, but the way things are priced is so fascinating. And I'm sort of just reminded of how money, and I think this is, like Elon's way of describing money. Money is just an information processing tool, right? It's just like a database of information, right? It just transmits information. That's really just the purpose of money. It's a kind of a communication mechanism for humans that we've invented to basically do trade and kind of cooperation more efficiently. Like if you're on a desert island in the middle of nowhere and you don't have any food or resources and you're just dropped there, a normal healthy person, but you dropped there and then all of a sudden you've got to figure out how to survive. Over a few days, you're going to start running out of food and water, and money is not going to save you. You're going to have to start using your ingenuity to actually survive. And so money itself, the notion of money, it doesn't have intrinsic value. There is no intrinsic value in money. This is the thing that a lot of people don't really realize. They work their whole lives for, some company that's paying them, tiny fraction of 1% of the value the company captures. And then the government's taxing you and printing more of the currency, the purchasing power of your currency is going down. And so basically you're working for nothing your whole life with the expectation that your money is actually going to be able to save you at the end of the day. And so, I mean, my way of understanding Bittensor is very similar to the sort of purest way of understanding Bitcoin, which is, and this is something I was tweeting about earlier. A lot of people are saying this, like the Trump family is saying this. I totally disagree with it, which is crypto is a hedge against inflation. At a speculative level, maybe some of that's true. But if you double click and triple click and you fundamentally understand the cryptocurrencies that are truly deflationary, there's two. There's not 20, there's two. There's Bitcoin and there's Bittensor. Bitcoin has a supply cap. It's cryptographically proven and unhackable for 16 years now. And it is deflationary. It goes through these halving schedules, and the purchasing power goes up in dollar denominated terms because the US Fed is printing more dollars. There's no supply cap. There's this expansion of monetary supply, which means that the purchasing value of each dollar goes down, and the purchasing value of each Bitcoin goes up over time. And so Bitcoin is not a hedge against inflation. It is the solution to inflation in the context of fiat. Now let's go and segue to Bittensor. Bittensor has the identical properties, but it is the solution to inflation in the context of equity. Equity, again, company equity, is highly inflationary in nature. This is not something we were discussing when we were in Toronto, and it has to be repeated 1,000 times because it's somewhat complex. Everyone should understand it. Equity has this fundamental property in companies, public and private, which is called share issuance. When you print more of the share supply, it is perfectly equivalent to the Federal Reserve printing more monetary supply. You expand the supply of the asset, more of it, basically, right? In short, there's more of the asset, and you're printing it out of thin air. You can do this arbitrarily. You can say, hey, look, I'm just going to double the number of shares of the company. Or arbitrarily, you can just wake up one day, get board approval, and do that. Right? And what does that do? It dilutes the shareholders, reduces the purchasing power of each share or the value representation of each share. And obviously, the shares have less value over time. Now, the big question of why do companies do this? Well, they want to raise more capital. And so they have to represent the capital that they're taking into the company in some way without diluting everyone. Oh, wow. Well, how does that happen? Well, they print more shares. Well, counterintuitively, when you print more shares, you dilute everyone. That's crazy.
It's so true. Like, the stock market is essentially a big dumb contract as opposed to smart contracts. And the dumb contract is, oh, you have a share of McDonald's stock, you own a tiny piece of McDonald's stock. That's just the dumb contract, because then McDonald's could, like you say, they could issue more shares. Startups can issue more shares. I've been in, and I'm sure you have too, I've been in many startups where I was a seed investor. You would think I would make the most amount of money, but then they raise more and more money. And whereas initially I owned 5% of the company, I end up owning 1/10 of 1% of the company because I signed dumb contracts and there's nothing I could do about it. And this is why you need an SEC. The SEC is out there to basically, you have hundreds of millions of dollars to fund this organization to basically try to make dumb contracts smarter so that people aren't screwed over and over again in the equity markets. I would challenge you this. Like, I know you invest, like the subnets are mostly run by companies that are like VC style companies, and you're a VC. And I would challenge you this. I would not invest in the equity of a single subnet owned company, a company that owns the subnets, unless I was willing to buy as much alpha as possible because I knew that the alpha was actually going to have the biggest value. And if I'm willing to buy the alpha, I'm not going to buy the equity, which is a dumb contract. The alpha is a smart contract in the sense it's in the code. And if I know everything that can happen with the alpha because it's in the code, and if I can see the incentives of the management team are in line with the alpha, I don't need to invest in the equity, which is, I don't know what's going to happen with the equity. They could issue more. They could start another company on the side. If I don't think their incentives are aligned with the alpha, there's no reason for me to invest in the company. And if that's so, should just invest in the alpha anyway.
It's a great prompt, and I'll offer some comments as to why I do this. Variety of reasons. And caveat emptor, I am a very seasoned professional at doing this. And I have certain ways of mitigating the risks of the things that you just pointed out. The predominant way I mitigate the risk of out of control, totally crazy and sloppy share issuance or equity share issuance expansion of companies I invest in at the earliest stages, which is mostly what I do. I lead seed rounds. We incorporate the company. Typically, most of the time we incorporate the company. If we're not incorporating it, we're the first equity investor ever by 10 to 20% of the company. My set of principles that I've adopted over doing this for the better part of a decade, close to a decade now, is that I try to instill the understanding of these things with the founders that I work with, such that they run the companies as capital efficiently as possible, where in the worst case, in the absolute worst case, they raise at most 2 additional financings after me, and where we have what's called pro rata rights. And pro rata is basically we get to invest a proportional amount to preserve our ownership of the company. We have to typically invest like 2 or 3 or 4, sometimes 10 times more than our initial investment just to preserve our equity. And this is a pretty common thing in venture capital. I'm sure you're familiar with it, but so the audience understands, because there's quite a lot of people that listen to us. This is basically where, imagine you have a pie and you have a sort of like right to a certain slice of the pie. Like you have sort of like, kind of like the rights of our constitution, like free speech, right to bear arms, like all these rights, essentially, okay? For being a US citizen, for people who are in the US, Western world democracies, essentially, a pseudo-democracy, pseudo-democracies. You have a right to a slice of the pie that you're granted in the beginning. Now imagine it's this huge party. All these people show up to the house. They start going at it. They start eating this pie, maybe even grabbing some of your piece, the piece that you have the right, the right on. And so, but you still have this right. So legally speaking, you can sue those people and you can do all this unless you are maintained that portion as the pie gets bigger and bigger, because you've got a chef making more of the pie. So there's only one pie, and the chef is just adding more and more sort of aggregate size of pie to satisfy all of the hunger of all the people coming into the party. So you've got to go to the chef and say, look, I was granted a right of always 10% in perpetuity of that pie, even if you're going to triple the size of the pie and make the pie 10 times bigger, because now there's like 50 people at the party instead of 5 people. My slice of the pie should now be 10 times bigger than it was. And so you've then got to go to the chef and have them make more of that pie for you. The problem is the chef needs more ingredients. He needs more eggs. He needs more milk. He needs more, more of these things to actually satisfy producing your proportionally larger increased slice of the pie. Now, he doesn't have the money. We don't have it in the house. He's got to go and pay someone to go and get the eggs and the milk and the baking powder and all the stuff to make your 5 times bigger or 10 times bigger slice of pie. So you've got to pay him some money. And the cost of paying the money is this notion of pro rata in venture capital. You've got to pay more to basically maintain the slice of the pie. Personally, and this is kind of a stupid example I'm giving, I think this is a completely broken system. I think it's a completely broken system. The way venture capital and private equity works with this notion of pro rata to prevent dilution of earlier shareholders is totally dumb, because typically pro rata is only good for the next round, only one round. After that, if additional financings occur, you do not have any more pro rata. You have to basically beg for your right to get pro rata, because what happens is the founders, when they're like, well, look, actually, it's going to cost us a lot of capital to build this company. We're going to have to go through the alphabet. Have to go through A, B, C, D, E, F, G to get all this capital in order to reach our milestones and build the great company that we want. The problem is most technology companies do this. And so you're only granted the pro rata right for maybe the Series A, or if you're lucky, the Series B. But as they keep raising money, you're going to get diluted down massively. And so this is a very big problem in the world of equity markets. And so what I do is I just advise all of our founders very carefully and say, you will likely be given help from me to help raise one more financing round or another one after that. I've helped companies raise billions of dollars from a lot of the world's best investors. My funds are very small, but I can help, and I have helped systematically our companies raise, in aggregate billions of dollars across, dozens of companies. The problem is this is a bad idea. This is not a good thing, because when you raise so much more capital than you really need, it causes sloppy execution. It causes this sort of delusion that you can do anything. Necessity is the mother of invention. Constraints drive creativity. When you have an absence of necessity and an absence of constraints, guess what happens? Things fall off the rails. The companies start going and say, we want to build 9 products instead of the one great product that we should really be focused on. Okay, so they start building 9 products. The 9 products are shit. They can't actually go and dominate the market that they set out to go and dominate and achieve leadership in, because they have such a glut of capital that it doesn't allow them to actually maintain focused degree of building the company. They hire too many people. All of a sudden, there's 100 or 200 people that they don't need. That's very bad as well. Most of the best companies in the world are run by very small, focused teams. And so, again, the tools that I have are not perfect and like guaranteed to solve these problems tools. But what I basically do with my founders is I say, don't raise more capital. What you should actually understand is I'm going to give you a few $1,000,000. My funds are really small. I typically invest $1 to $5 million. I'm not a large asset manager. We invest seed capital. The largest investment I've ever done is like $10 million at the stage at which we invest and lead around. That was actually in the company Manifold. And I say, don't ever raise more money after us. If you do, it's like one more round, but it better be at a very high valuation where you're not going to be diluting too much, because otherwise my equity incentive actually goes down. I get kind of pushed down the cap table. And I'll share something with you just to kind of end this rant. I was sitting down with a couple people in the Bittensor community. I won't mention who they are, but they're very seasoned and experienced people. They may or may not be one of the founders. And I explained this. I explained all these things, this notion of dilution of shares and pro rata. And, so venture capital is sort of like, if you, just like you said, you led the seed round, but the company sells for $1 billion. You made like $100 billion, right? You may have only made 5 million because you got diluted down by 70%. Like, I explained this notion and they were like, wait a minute, that's a scam. That has to be illegal. How is that the case? Because when you buy 1% of the total potential supply of an alpha token, which would be 210,000 alpha tokens, because the total supply is 21 million, you will always own at least 1%. In fact, if they do a burn of the alpha token, because they can't create more, they can burn some, you will actually own more than 1%. Your ownership will go up, not go down. So it is the opposite with alpha tokens on Bittensor. It's the opposite. The final thing I'll say is the reason we try to optimize for the right equity terms when making investments in subnet teams that happen to have companies basically is that it creates a symmetry of representation alignment. There's multiple value representations. Company equity is just, for better or worse, a more durable, a more mature way of creating incentives between people who are creating entrepreneurial activities and businesses and so on and so forth, right? And as we mentioned earlier, we're 400 years into this experiment of companies. Now, Bittensor, we are 9 months into the experiment of alpha tokens, right? So we just need more time. But I think at a fundamental level, I agree with you. I think you would want to optimize for the ownership of an alpha token. The challenge is, and again, this is what we're seeing as well in the market, and this was the case as well when the United States stock market was created. We went through decades, many decades of pure speculation in terms of trading activity, right? When Alexander Hamilton created the stock market from the Bank of the United States to the initial bond market and treasury market that emerged after the incorporation of the Bank of the United States in late 1770s into the 1780s, for the first 100 years of our nation, of the United States of America, from the 1780s to the 1880s, the trading flows and activities of those assets and instruments, which were US bonds, were extraordinarily speculative. The reason is the age of our nation was also extraordinarily speculative. We weren't a proven world dominating entity. We were far from the most dominant, most powerful nation in the world. We didn't have the most powerful military. We didn't have the most powerful technology. We didn't have the most powerful industry, all these things, right? And so these cycles just repeat over and over and over again. That's why Ray Dalio is very correct when he says we need to study history and look at the age of companies in the same way that we look at the age of nations, because they go through these cycles of maturation, highly speculative initially, price discovery, where you start to see more value-oriented trading. And then ultimately you end up with a very mature, established institution that is either adaptable and can survive these kind of like trying, testing evolutionary periods, or becomes corrupt and completely implodes. And then you have a regime change, a complete change of control, both in terms of the, sort of like ideological and political structures, and or stasis and success. But I mean, as we know, with the economic situation and the debt to GDP issues of many of the top fiat currency based nations, it's not one nation that is having these issues. It is essentially all nations that are having these issues in terms of their fiat currencies.
Right. And that's why, look, what you said makes a lot of sense. The notion of a corporation with equity has been around for 400 or so years. And so when you're thinking of investing in something that makes money, a company, you look to buy the equity. But this is evolving. So we're in this transitory period, I think, even though 99.999% of the world's not aware of Bittensor, we're in this evolutionary phase where I think it's going to settle on the Bittensor or the Tao model. And I'll take your example. So when you invest in a company, you described two things that I think are, I don't want to say scams, but I think are less evolved than what Bittensor does. And this is a new way of thinking for me. But you described your pro rata rights. Now, those rights are written down in a dumb contract. It's written down, and printed up on a piece of paper, and a lawyer says, yeah, I think this is good. And the lawyer on the other side is, I think this is good too. But one side or the other could break the contract, and then you've got to go to the SEC or you got to go to a judge, and the lawyers argue.
Which no one does because it's not worth the time.
Right.
It's cost prohibitive. And you just violated trust. And so you just write the company off or you write the founder off and never invest in them again. But no one enforces these things.
Right. And so that's the nature of a dumb contract, is that it can be broken and there are consequences. Or the other thing is, like you say, you work with the founders and you obviously know and trust the founders, else you wouldn't invest. And so you're dependent on the founders' goodwill, that they're going to, in the long run, agree with the discussions that you're having with them now, and all's going to be good. I would argue that, again, if, let's say, an owner needs to raise money, that means the owner thinks for every dollar of equity they give up, that their equity is going to be worth more money in the future. That's called being accretive. So I'm only going to raise $10 from you. If I'm a company, I'm only going to say, JJ, give me $10 and I'll give you $10 of equity if I think the equity is going to be worth more than $10 to me. So in that sense, the owners of every subnet have 18% of the emissions. They should, if they really want money and they think the money they raise is going to be accretive, meaning it's going to drive more value than if they don't raise the money, they should sell part of their alpha tokens that they're getting as owner of a subnet. And because, hey, they're alpha, let's say they don't have 18% of the alpha anymore, they have 16% of the alpha. And I just sold 2% to you, JJ. Well, I think my 16% is going to be worth 10 million instead of the 8 million it would have been worth if I had 18%. I'm better with the 16%. So the alpha ultimately is going to replace equity, because if the incentives are all aligned, you don't need all the dumb contracts. So it's your obligation as an investor and this is, by the way, not just for VCs. This is the benefit of this. This is for all the people arguing on all the Telegram boards and Discords. Your job as an investor is to make sure the alpha token holders, their incentives are aligned with these subnet owners' incentives, are aligned with the miners' incentives, are aligned with the validators' incentives. That is the due diligence that has to happen when you invest in a subnet company. And then I would say we will move, by the way, then you're not dependent on the goodwill, because the incentive mechanisms could all be coded up. Like whether I buy back alpha tokens out of my revenues, that could be encoded into the incentive mechanisms. So I, as an investor of alpha, will see that I'm not dependent on the goodwill. Oh, they might buy back tokens, they might not. But here, it's in the code, and they can't go back on the code, depending on how it's coded up.
There's more and more guarantees that are possible with incentive mechanisms on Bittensor, which I would agree are a type of smart contract. And Ethereum sort of like pioneered this notion of smart contract. I think Bittensor is extending on it.
Yes.
Basically saying at the level of the competition and the game that the token encourages or sort of elicits from some community of participants and contributors, aka the miners, you can codify many of these rules. And this reduces the level of trust that you need to concentrate on management, on founders, on the people running the competition. And this is a very healthy thing. But to your point, which is, again, the fundamental sort of lossy and very messy flaw of equity markets, the trusted nature of how management behaves, how they make decisions, how they build the product, how they ship, how they make and set expectations and deliver against those expectations over very specific timeframes, quarterly earnings, right? Like we've got, quarterly updates that the markets see. If there's some malicious behavior, markets will sell off. Like liquid stocks have some good properties in terms of creating less asymmetry of information where there's more symmetry, there's more universal understanding of how management behaves. Alpha tokens have similar properties. The challenge is when something is being invented and created as a digital commodity or as a startup, if you will, to use that analogy, from inception, and the representation of the value of that is liquid from the very beginning, right? Which is what these alpha tokens are basically providing. Your level of volatility is off the charts, right? Like,
Yes.
people will go crazy just based on some hypey narrative, and your alpha token's going to trade up like nothing you've ever seen. And then when you fail to meet those expectations, or the product doesn't actually, or the commodity doesn't actually meet the expectations, people will sell off, take profits, and you're going to have to rebuild trust over and over and over again. And I think this is kind of a normal phenomenon in any highly speculative asset. And by the way, something you mentioned around M&A made me think, which I think is very true as well. In the first couple of years of Bitcoin, JP Morgan Chase, or one of these big institutions, Goldman Sachs, they could have bought all the Bitcoin. It was worth what, 10 mil or 5 mil or something? They could have been like, all right, interesting. We're just going to buy all of them. And we're going to just OTC and buy all the supply. Well, the kind of crazy thing is they wouldn't have been able to actually buy all of them because the Bitcoin in circulation in the first couple of years was only like 1 million or 2 million Bitcoin. But they could have actually bought 1 million or 2 million Bitcoin from people for probably less than a few $1 million, or maybe $5 or $10 million, right? Because in 2012, there were 10 million Bitcoin in circulation. Remember the first halving, right? This is the same thing happening with Tao now. Tao in circulation is right now is almost 10 million Tao. Right? No one has 10 million Tao. The largest Tao holder has like a couple 100,000 Tao. Right? So no one has 10 million Tao. So if you wanted to buy all 10 million Tao, you have to do a pretty big transaction. You have to put $3 billion together and get hundreds of thousands of unique individuals to agree to sell you their Tao. No one can buy Bittensor. Bittensor is a federation of hundreds of thousands of Tao holders that no company can buy. There is no single AI company that has hundreds of thousands of equity holders. Not Anthropic, not OpenAI, not Mistral, not Grok, not Cerebras, none of these companies, not even NVIDIA. You can't even buy NVIDIA because, NVIDIA is $4 trillion. No one has $4 trillion to buy all of the NVIDIA shares, right? Unless you're the Sovereign Wealth Fund of Norway or something, and you work with Saudi Arabia and you combine your capital and you go to Jensen and say, look, we're going to buy the whole thing for 10 trillion. We'll give you a 2x multiple. Like it just wouldn't happen.
Yeah. And, I think with Tao tokens, there's very authentic demand. So I look at that company, Ridges. They spent almost no money and they built a multi-billion-dollar company. Okay, now there's demand to create a subnet because everyone sees subnets create value. You need 1,000 or so Tao, maybe more, to register a subnet. Then to be a miner, you need to get a hotkey, right? You need to spend some Tao. To be a validator, you need to stake some Tao. So there's authentic demand. As people are aware of Tao, there's authentic demand for Tao. And then, of course, there's speculation and investing, which always drives some price. And it's the same thing with the subnets. I agree there's a lot of volatility in subnet prices, but that's mostly because, again, like any maturing industry, many subnet investors, I would argue 80 to 90% of subnet investors don't really know what they're doing. And this is not a criticism. This is the same percentage probably in the stock market, but people are more familiar with the stock market because it's older. But I would encourage, when you're investing in a subnet, do what JJ just said. Is this subnet creating a product that has a big market? Is the team good at executing? Do they have the right ideas and so on? So that's the basic first level of subnet analysis. But then the second thing, which you do in a different way when you're investing in equity of startups, but you have to look at does the CEO have skin in the game because they get alpha tokens just like I would get alpha tokens when I invest in a subnet. We have the same skin in the game. But is the CEO or the founder really aware that the miners have to be incentivized, that the alpha token holders have to be incentivized? Is there a need? Does he really need his miners, or can a Google replace his miners? In which case, the incentives have to be structured a little differently. So you have to do this style analysis, and I find that 80 to 90% of subnet investors don't do it, hence the volatility. And even with the ridges, subnet investors see, they just broke the benchmarks, so they run it up 1,000%, and then, it's not continuing to go up, so they sell it off 900%. We get that kind of volatility because people don't really know how to analyze yet. And even the subnet owners don't really some of them do, some of them don't. I'm seeing it more and more, even in the just past few weeks. But out of the dozen or so subnet owners I've spoken to in the past week and a half, I would say it's 50-50 whether the subnet owners even understand how important it is to incentivize their alpha holders. Their alpha is going to go to zero in the long run if they don't. But on Bittensor, you can't just have a research project be funded by alpha holders because they don't have any benefit in the long run. People need benefits, which sounds selfish, but actually, the Western economy has shown selfish is not the right word, but having everybody's incentives aligned and everybody benefiting is the right way to build a society, an economy. That's why the United States doesn't starve, but China, which had a centralized economy in the 1960s, 40 million people starved because the incentives of the government were different than the incentives of the masses of people. Whereas if you let things sort of be priced in a free market, then nobody starves. It's assuming the resources are on the planet. But anyway, I think this is sort of like an evolution of our discussion about alpha tokens versus equity versus, what is the ultimate value of alpha tokens. And you've convinced me, JJ, that these alpha tokens are not only valuable, if the subnet owner realizes that he needs to make value there, they're not only valuable, they're more valuable than equity. And I'm at the point now, a complete reversal of where I was just 3 weeks ago. I'm at the point now that if there's a good subnet, I'm only investing in the alpha. I don't want the equity because I don't want that headache of goodwill and dumb contracts.
Timing is everything. And there's something that I have not figured out the answer to because I feel like we're on the precipice of really deeply questioning these assumptions and variables. And I'd love your perspective on it. It's something I've been thinking a lot about. So what traditional markets tend to look at as the ultimate way of valuing companies is this thing called the DCF model, discounted cash flows. And so you put a discount on the future long-term ultimate potential of all cash flows the company can generate. And this is a very common conventional model. You sort of like ask any investor, the sort of like the poker tell, if they really know what they're doing. To the answer to this question is, if they give any other answer other than DCF, they have no idea what they're doing, which is like, how do you ultimately value a company? What's the ultimate measure of value? The challenge with this DCF model is that the US dollar is potentially collapsing. I mean, the data shows, like hardcore data, is purchasing power of the dollar has been decreasing massively every year for the last, 60, 70 years. Right? So this is a problem. So when you then sort of ask the question, how do you value all future companies? Is it the DCF? I don't know what the answer is. And I think you also have to look at alpha tokens and subnets. If objective function and the sort of fundamental driver of these subnets is, and Ridges is a good example, right? What Shaquille's been doing has been just mind-blowingly impressive. And I think this should just be on Bloomberg and TechCrunch and all the news outlets. Just people just don't take Bittensor seriously enough, which is why we do this show. But it's truly insane how much progress Ridges Subnet 62 has accomplished in just a couple short months, spending, on the order of around $1 million to produce the same model performance results as top labs that have spent billions of dollars. By the way, in the top AI domain with the fastest growing revenue generating companies, which is code generation and software engineering, right? When you build a product, let's say you build Ridge's commercial product, right? And it's Cursor competitor, or it's the Anthropic Claude Code competitor, one of these coding agents. And you price it more competitively, right? Undercut, it's a better product, has all these additional features, it's more differentiated, and you have a way of like, there's some IP, there's like a moat there, whatever it is. But you're fundamentally going and saying, we want to get to 100 million in revenue, right? In, a year. Okay, great. These sound like really big assumptions, but look, great. Get to 100 million in revenue. Say over the same time frame, the dollar continues to drop in purchasing power. You got the 100 million in revenue. Are you going to be valued in the multiple of that revenue based on the current market rationale of pricing companies based on the multiple and the growth rates of their revenue in a regime where potentially we see a slower GDP print and growth than we've seen in the last decade? I was watching an interview with Larry Fink, and this is a really sober gentleman, right? Like runs BlackRock, co-founded BlackRock. I believe they manage about $13 trillion on behalf of their clients. So a very large institution. And he was like, he essentially said this, that it was just trying to be more concise here. But he was like, we have a clusterfuck situation in America. Right? He essentially said that. He was like, it's a complete mess. And he's like, the only way out with the debt situation, he's like, we're huge fans of Bitcoin and we have 100 plus billion in these Bitcoin ETFs. The only way out is growth. If the United States does not grow 3% a year for the next decade at a minimum, I do not see a solution, and the dollar will lose its reserve status. And it is not a right, it is a privilege to have the world reserve currency be the dollar. It is not a right. It is a privilege of ours, and we are going to lose that privilege if we don't grow our economy 3% a year for the next decade. And guess what? I ran some of the math. 3% a year over the next decade means we need to come up with $8 trillion in net new GDP, or roughly every year around 700 billion in net new economic activity for roughly every year of the next decade. And unless financial services grows by 30% compounding every year, which is roughly the largest industry in America, we will not get there. And there's a lot of assumptions in here. We'll have 2 administrations. We're going to have potential geopolitical issues that are unpredictable. We'll actually have to see whether or not the market continues to value these AI companies at the level they're valued at, where they're almost all negative gross margin businesses that are not profitable, that are not generating free cash flows, except for a couple like NVIDIA, which is reliant on the gigantic premium people are paying on these processors, which, by the way, is almost insane, right? Like the margins are software. NVIDIA has software margins, and they produce designs for hardware chips that are ultimately sold at a hardware level margins. And so I think it's kind of an interesting question. I don't know what the answer is. Do all businesses, including Bittensor subnets, find themselves optimizing for revenue in the form of dollars that is then represented back? Or is it something else? I just don't know what the answer is. And it's not an immediate term. It's not an immediate term question. It's more of a 5 to 10 year kind of question, or 15-year kind of question. But it's not 20 years, 50 years. It's
right.
5,
and I think
years.
it's an interesting challenge. Like, is the DCF model, which basically says a company's worth all of the cash it's going to generate, discounted back by other safer investments that I could do. So it's related to, hey, I could make 4% a year just owning treasury bills, which are pretty quote unquote safe. Set aside inflation for a second. You better give me more than 4% a year, because a corporation is not as safe as the US of America, USA. But you may break an interesting, it's always worth doing the thought experiment of taking this concept that's 100 years old, DCF, and questioning it. And it's great that you're questioning it. And you're right. Like, I would say maybe better than DCF is to analyze not the discounted cash flows of a subnet, but the incentive mechanism. And will I have a better return on my money because of this company's incentive mechanism than I would have elsewhere? So rather than being paid a dividend out of the cash flows, will I generate more alpha tokens, and the alpha tokens will be worth more because I'm investing in this company versus investing in T-bills? So the company doesn't have to have any cash flows at all. They could just have a way of burning alpha tokens, and that will make my investment better. So that kind of, again, is this evolution of a company, which is what subnets are turning into. This is why Bittensor is so incredibly valuable. We always say people don't realize it yet. I don't know why that is. Eventually, I think part of the reason is because people don't understand that these alpha tokens are not meme coins when in the hands of the right subnet owners. I think
It's also very complex.
Yeah.
We're making immense contributions to make it less complex. I think we've reached many hundreds of thousands of people that have listened to our show. But going back to your initial comments when we started this episode, it's a complex technology. It's more complex than Bitcoin. And Bitcoin is only now really starting to penetrate mainstream after 15 years. So Bittensor, we need a catalytic way of connecting all of these concepts. I think we're going to get there. I'm very optimistic about this, but I think the reality is it's just like way more complex than Bitcoin.
Right. Like, this is why, like, you take Hyperliquid, which I think is, so that's a DeFi exchange. I think it's like a $12 billion market cap or something like that. And I get it. Wall Street understands what an exchange is. That's what they do. And there's customers paying fees to trade financial instruments. This is Wall Street understands it, so it's worth $12 billion. The leaders in almost every other category of crypto are worth in the 10 or tens of billions of dollars. Bittensor is the leader in the AI category. It's worth $3 billion and arguably more valuable than these other things because there's no competition, by the way. Hyperliquid, there's a new competitor being made every single day, actually.
In fact, there's a Hyperliquid on Bittensor subnet.
Yeah, just launched this week. So Subnet 35, Kartha. So I spoke to those founders too. Extremely smart guys, brilliant, and it's going to be exciting to see what they do. Now, JJ, this was a short episode. I have to kind of jump to another podcast, but I think we've very much covered kind of this idea of an evolution of equity and how it's playing out in this pure way. And I will say this, if any subnet owner wanted investment, I'm still only buying the alpha. And I'm not doing that out of charity. It's because I don't think a subnet is valuable unless the alpha is incredibly valuable. I know you have your reasons for investing in the equity, and I agree with those reasons that right now the market still values dumb contracts and goodwill, and that's how the economy understands companies, but it's evolving.
I always enjoy the show, and thank you again for the great conversation, James. It's great to see you.
Shortest episode ever.
Good to see you.